And let's have a look here for our chart of the day, because it's a chart of US. We're going to switch gears and look back to our friends, the Fed. This is from Cameron Harrison, and the gap there between the Fed funds rate, which of course is at near zero, and wages growth. So while you probably heard all morning about how payrolls disappointed on a Friday, and they certainly did, wages growth month on month was actually double market expectations. So I think we need to talk about that as well. So the author of this chart, because we have seen the low in bond yields, but where are they going to go? Our next guest has some eye-watering predictions, so grab a stiff coffee to get through talking to Paul Ashworth, CIO of Cameron Harrison. Good morning, Paul. How are you today?
Good, Annette. How are you?
There he is. Mate, I nearly choked on my coffee when I read your notes this morning. So let's tiptoe into this conversation. So not that long ago, US 10 years, probably, I don't know, just say the lows were 118, give or take. Yep. We've seen the low. Nothing moves in a straight line. But where is it going from here?
Well, I think the important thing from our perspective is the time prism that we're looking through, Annette. So we're looking through a 12-month prism in terms of considering where US 10-year treasuries may be, and then from that perspective where they might go. So from our perspective, looking through that 12-month time prism, we think the conditions are still pretty ripe there for above cycle economic growth. We think that fiscal stimulus is still supportive, albeit we see it moving away from direct stimulus to that longer duration infrastructure spending. But as you rightly pointed out, the key to all of this is wages growth. As you can see there on that chart, wages growth approaching 4%. That indicates to us, together with pretty robust economic conditions, a 10-year bond rate around the 3% level. So the next thing for us then is to consider is how long can that be sustained for in terms of that wages growth. And I suppose the eye-watering part of that is if we see sustained wages growth, then a 10-year bond rate approaching 4% is something that could be penciled in.
Well, as we were just discussing with our last guest, a lot of this words and deeds has to be mixed in with a good deal of optics. So how does the Fed sell the story? Because they've spent years talking down every single sell-off in the bond market. How does it manage expectations without dislocating the market?
Yeah, look, and that is a significant preoccupation. The markets have, I think it's fair to say that they've probably self-selected a ceiling on rates of 2.5%. We're not sure that the Fed, in terms of the domestic side of things, are going to subscribe to that self-selected rate. Certainly, elevated rates would have a significant dislocation, a potential dislocation for offshore markets, particularly emerging markets. But we're less convinced that at that 2.5%, if you like, market self-selected basis, that the Fed will veer away. We can see as the Fed can probably start to see that the US economy really hasn't kicked in all of its jets yet. From a growth perspective and from a utilisation of surplus household savings. So there's a reasonable capacity there for the domestic economy to absorb 3%. But you're absolutely right. We'll have to tread tread very carefully, to manage that market's self-selection at around 2.5%.
So the two big negatives in the US at the moment are supply constraints and Delta. It feels like neither of those are going away anytime soon. So does the Fed just buy itself time by saying, look, we're tapering, but we're years away from tightening?
Look, obviously there's a risk in that, isn't there? Because to the extent that tapering is to continue, there has to be a join there in terms of the monetary settings. Look, Annette, I think that is one of the risks. This prism of a 12-month outlook. There's going to be a lot of machinations and permutations ahead of us. Notwithstanding that, I think the greater risk is where the Fed often finds itself, and that is that it's late to the process, and that wages growth and inflationary expectations, because that really is the key thing that we've got to be mindful of, is inflationary expectations. If they become reasonably entrenched, then the Fed, with a history of being late to the rise, and then when it does arrive, being too hard in its actions, risks the economy dipping into recession of its own making. So I think that's probably the greater risk, is that acquiescence leads through to significant inflationary expectations, and I think they're mindful of that. I don't think it's like the post-GFC market tantrums. I think they are very mindful that this time, that inflationary expectations could become entrenched, and that would be a whole lot more difficult for the Fed.
Well, what's difficult for the Fed, I thought, was that payrolls report, because Delta really put the dampeners on services employment, hence the disappointment. But as you say, wages did well, unemployment, underemployment, all those other key metrics actually did really well, but the markets ignored it. Is that the market risking behind the curve, not just the Fed?
No, that could well be the case. There's certainly no doubt that Delta is having an impact. When we've previously caught up, Annette, we have had a good chat, in terms of the services economy in the US. So that is going to have an impact in the effects of Delta on the services economy, and it will be a very important watch point. If services continue to be suppressed, I think where we get to under that type of environment is it just becomes a changed time frame. I think there's an inevitability to this in terms of pressure on longer term interest rates, but the stone or the pebble just gets kicked down the path another 6 months.
So in the meantime, short duration, long precious, long defensives, how are you playing this?
Look, at the moment, we sit in the industrial space. We're still with good cyclical leverage there. We do have clearly some difficulties ahead in terms of Delta and its immediate impacts, but the firepower that's there, the fiscal conditions that remain, and the US government's understanding that they have to stick to the fiscal course here or risk deflationary pressures again, sees us still positioned in the smart industrials, in the technology-enabled industrial space.
Well, it sounds like you're setting us up for a rough ride next year. I'm looking forward to that. Thank you, Paul Ashworth from Cameron Harrison. Enjoy the rest of your week.
Thanks, Annette. You too.